Hi everyone, welcome back to Commerce Student. In today's video, I'm going to discuss about accounting concepts along with their types. In my previous video, we studied about the basics of accounting principles. If you have not watched that video, I have provided the link in description. You can watch it from there. Now let's get started. Things we will cover in this video. What are accounting concepts and some of the types of accounting concepts. Let's discuss these one by one. What are accounting concepts? Accounting concepts are one of the types of accounting principles. These are the basic principles guiding how to record and report financial transactions of business. These have been developed over the years from experience, and their main purpose is to understand the effect of recorded transactions on profits of business. Types of accounting concepts. There are 10 basic accounting concepts, that is business entity concept, money measurement concept, and so on. In this video, I am going to explain you first 5 accounting concepts, starting with business entity concept. Business entity concept. According to this concept, there are two entities in accounting, that is the business and the owner. It states that business is treated as a separate entity from its owners, and there is always a line of demarcation between business and businessman. Accounting is to be maintained for business and not for its owners. This distinction is crucial for recording transactions between the business and its owners as business transaction. In case this concept is not followed or the line of demarcation is not treated between the entities, then business affairs will be mixed up with private affairs of owner, and the true picture of business will not be available. That's why, for accounting purposes, a distinction should be made between personal transactions and business transactions, and transactions of one business entity and those of another business entity. Let me further explain this concept by providing an example. Suppose ABC company needs to prepare a profit report, and for that it has to calculate the amount of profit earned by deducting expenses from incomes. Say the income of business is 50,000 rupees, and if the household expenses of owner are shown as business expenses, which are 10,000 rupees, then the profits of business will be understated to the extent of 10,000 rupees, which is a wrong figure. Because the distinction between personal transactions and business transaction was not made. Therefore, such distinction or separation will help accounting in reporting profitability more accurately and fairly. Money measurement concept or assumption. According to this concept, only those transactions find place in the books of accounts which can be expressed or measured in terms of money, that is financial transactions. In other words, if a transaction cannot be measured in money terms, it should not be included in accounting records. Such transaction is known as non-financial transaction. Let's look at some examples featuring the importance of money measurement concept. Suppose there are two parties, A and B, who enter into a transaction where A delivers goods to B and in return B gives cash to A. This transaction is a clear demonstration of money measurement concept because the value of the goods delivered can be measured in money, which is the cash exchanged between A and B. In our second example, we see a scenario where the sales director of a company is not on the speaking terms with the production director. As a result of this situation, the company is bound to suffer, but its impact cannot be measured in money, as it does not involve a direct exchange of money. This is a non-financial transaction. So, this concept states that money is the common measuring scale by which we can ascertain the value of things in business, like assets, liabilities, incomes, etc. And money serves as a medium to value quantities in accounting. For example, instead of saying a firm has 20 chairs, 5 tons of raw materials, and 3 machines, we can simply assign monetary values to these assets. Like chairs worth rupees 6,000, raw materials worth rupees 10,000, and machines worth rupees 60,000. By doing this approach, a company can maintain meaningful and systematic records. In India, rupee is the legal currency for measurement. Going concern concept. This concept is also known as continuity assumption. According to this assumption, business is normally viewed as a going concern that will continue to exist and operate for long term in future to fulfill its objectives and commitments. It tells us that the life of business is fairly long until and unless the liquidation of business does not take place. Liquidation means winding up of business when the business shuts down or closes and its assets are sold off so as to pay off its liabilities. Therefore, the continuation of business operations will depend on future events, and all the financial statements are prepared under this assumption. That is, the business entity will remain operating into the foreseeable future, which is defined at least for the next 12 months. For example, X started business this year, 2024. Now we won't say that it will close down very soon. It's assumed at least for next 12 months it will continue its operations. Then next year and so on. And that's the concept of going concern assumption. It's because of going concern assumption that assets are classified as current and fixed, liabilities are classified as short term and long term, and earning power is the basis for valuing a continuing business. Accounting period concept. It's also known as periodicity assumption or time period assumption. This concept is closely related to going concern assumption, which assumes the life of business as continuing unless there's evidence for its closure. So, because of this assumption, accountants divide the business's indefinite life into specific accounting periods like months, quarters, or years. Normally, 1 year is taken as accounting year. If accounting year starts from 1st January and ends on 31st December, it is called a calendar year. And if accounting year starts from 1st April and ends on 31st March, it's called a financial year. So all the business transactions that take place in a specific period are to be recorded as well as reported in that period. To know the business's financial performance, that is profit or loss figures, and financial position, that is position of assets and liabilities. Due to this concept, all the items of revenue and expense that occur during a specific accounting period are to be taken into account for that period only because of their time relevance. Historical cost concept. According to this concept, when a business acquires an asset, it is recorded in the books at the price it was purchased for, that is cost price. And this price becomes the basis for accounting for the asset in the future. For example, in case of calculating depreciation on asset, the amount of depreciation calculated is based on the cost of asset, which is recorded in books, and not on its current market value. So it's important to note that assets are recorded at their book value, which is their cost price, and not at their current market value, because market value keeps changing with changes in price level from time to time. Suppose a company buys a delivery van for 20,000 rupees. Now, according to this concept, the company has to record this van on its books at the purchase price, which is 20,000 rupees. And this price will become a basis for record keeping of van in future periods, even if the market value of van increases or decreases. If it increases to 25,000 rupees, the company would still report this van on its books at 20,000 rupees. This ensures consistency and accuracy in financial reporting. That's all for this video. If you found it useful, give it a like, share it with others, and please subscribe to my channel. Press the bell icon for future notifications. Until next time, keep learning and growing. See you in next video.